Well, thanks Sue, Justin and Kathy for that. I didn't choose Sue, Justin and Kathy or ask them for any particular reason, except that I just thought they were three typical people in the office, and that wasn't to say that any of their staff are less important. It was just three representative people in the office that I wanted you to hear a little bit about. I also wanted to especially thank Kathy, who's been quite ill and has just risen from the grave today to step up to the plate. So that's why, if she, that's that's why she was working very hard to get through that. Okay. Okay, so I wanted to spend just a little while going through a market update and outlook now. Because we know how important it is that you know, people have confidence in what we're trying to do for them. And this market is down by 28% since its peak in November. Now, I've been involved in the share market since the very early 1990s, and this is the fourth downturn that I've been involved in. It's the third one that I've been involved in professionally, and if you count when I first started investing, it's the fourth one. It's probably the worst, and it's certainly the one that's come on with the most sudden or most rapid onset. The things that have really caused that are the credit crisis, which I'm sure you've read about in the newspaper, and that comes comes back to some lending practices that had taken place in America, where that obviously weren't clear at the time, and where banks had lent money willy-nilly to people that really couldn't afford to pay, on the premise that if people had if all these investors, regardless of their credit quality, were wrapped up in as a group, then if a couple of them went broke, it wouldn't matter. Okay, but if they all can't afford to pay and they're all wrapped up in a group, you're no better off, because they've all got exactly the same problems. You know, a group of people that can't afford to pay is just as bad as one person that can't afford to pay. So there was no diversity. The argument was that they were setting up these portfolios that were diversified, and they just weren't. So that's that's really the guts of what caused the credit crisis, and you've probably heard the words CDOs, collateralised debt obligations, and subprime, and that's what all that is related to. At the same time, we've had Eastern economies such as China and Japan in particular, and Western economies driven by the wealth that was coming out of the financial sector to increase the demand for commodities, which has increased, which has led an overall global growth that's led to increases in inflation. And when you have increases in inflation of that, you may know that interest rates comprise an inflation component and a real cost of money component. And when the inflation component rises, interest rates as a whole rise. And that's exactly what's been happening. Compounding that, or a clear proof of that story that I've just told you, is the rapid increase in the oil price which has occurred, and that's driven by increased demand. So it's fair to say that we anticipated some of this, and in fact, if you read our December newsletter, we clearly said that we thought things were going to be a bit weak. But I have to say that we underestimated its impact. As I said, it was the onset was much more rapid than we anticipated, and the subsequent declines have been quite severe. So what did we get wrong in that? First of all, we were underweight resources. Now the resources market up to date has held up fairly well in this bad market. We did expose people over the last years to resources stocks, but when, for example, Rio Tinto hit about $80, it was above most valuation levels, and so we sold them out. So people haven't been exposed nearly as much to resources as we normally would have done, and that was because we judged that the prices of those resource stocks were too high. Now, in hindsight, we judged that too early. But resources don't pay significant yields, and many of the portfolios we set up are set up to provide income for people. It's to provide long-term income, either to build portfolios or to satisfy income needs for retirement. resources aren't a good way to fund that, because with resources they pay very, very small yields and you're relying on the capital gains to fund your income. If you always have to sell investments to fund your income needs, eventually you don't have any investments left. There's no more units. So it's a compounding effect in reverse. So that's one of the reasons why we've steered clear of resource stocks. And also, despite what you read in the press about how good they are and how well they've performed recently, historically they've been very risky exposures in portfolios. So they've been very volatile and quite unpredictable. Another mistake we made is a couple of investments that, after research looked sound, were not sound, and probably the main example of that was the Allco group of investments. I took the trouble to go down to Sydney and I spoke to the management in Allco, and it seemed like it was okay, or it seemed like it was actually quite good, but we got it wrong. And then finally, the hybrid investments, which normally would be very, very sound in a portfolio and not move very much, have, because of the rapid rise in interest rates and the questions over credit quality caused by the credit crisis, have fallen by a lot more than they historically would have. Now, you would expect that over time that will resolve itself. The companies that issue those securities have to pay back the face value of them. And so as long as those companies are around, the face values of these investments will be returned. And to date, there's only been one that's been in any trouble at all. So, I'm very, very confident that our strategy there's been right, notwithstanding the prices are marked down in the short term. Okay, so that's the admissions of error, but I think you've got to balance that up against what we got right. First of all, we've had wholesale avoidance of the worst calamities. So you can pick up the paper any day over the last 6 months and I'll guarantee there'll be at least one of these things in there. We've had absolutely no CDOs, collateralised debt obligations, in our portfolio. Now, I get called up every second day by brokers saying, look, you've got to take some of this or that and put it in people's portfolios, and it's my job to filter those things, to offer the good ones to you, and to tell the brokers to get on their bike if they're the bad ones. Okay, so I said no to every CDO. Now, a lot of those CDOs are in real trouble and many of them have gone broke. No ABC Learning Centres, which was a very, very popular Queensland-based stock. Lots and lots of people around have got that in their portfolios. We don't have any. No relationship with failed margin lending arrangements. There's Opus Prime and Lift Capital and a few of the others, which were very, very popular things. We haven't had anything at all to do with those. No failed hedge funds for quite probably 18 months or so there. People were on the phone all the time. David, hedge funds is the go. You don't understand it. The hedge funds are so clever that they can invest in up or down markets and they always make a 15% return. Well, I actually do know how hedge funds work, and that's why there's none in anyone's portfolio. General Property Trust was probably one of the first stocks that we ever had in Sandra and my portfolio. It was a fantastic investment. It contains a lot of the really, really good quality buildings in Australia. But about 3 years ago, they changed their management model such that you weren't just investing in buildings, you were investing in the management prowess, supposedly, okay, overlaid on these buildings. I didn't like that arrangement. It was much, much harder to value, and the prices that people were saying that this management prowess was worth were just over the top. So we sold all the, except for one client who wanted them, we sold all the General Property Trust out of clients' portfolios and replaced them with duets. Well, General Property Trust, you've been reading about in the paper, and it's having a lot of difficulties now because of those reasons that I had identified 3 years ago. And the duets have held up really well. Bris Connections was a toll road that listed last week in Brisbane. Macquarie Bank were on to me, hammering me, you've got to take some of this, and really been quite forceful about it. I emailed them and said, no, we can't do it. I just don't think this is going to perform well, and I'll take whatever punishment you'll dish out, but we're not doing it. And lo and behold, last week it listed, it was at $1 and it listed at it cost $1 and it listed at 35 cents. Okay. No MFS, which was this terrible damn thing that was based in the Gold Coast. Someone